Hello and welcome to the Morningstar series, Ask the Expert. I'm Emma Wall and I'm here today with Morningstar's Daniel Needham.
Hi, Emma.
Hi, Daniel. So we had the Morningstar Investment Conference last week and you gave a really interesting talk about risk, perceptions of risk, realities of risk. And I think one of the things we've seen over the last couple of years, since markets have rallied but with added volatility, is that people confuse risk with volatility. Why is that?
I think that the idea of volatility being risk relates back to this idea of what drives prices in the markets. And so there was a view in the 60s that, well, actually earlier than that, but primarily in the 60s, that prices were random. And therefore, if something's random and it follows a certain type of distribution, which in this case is normal distribution, you can assume that the relationship between losses and volatility or standard deviation are quite strong. So it's a statistical framework. And so due to sort of what was academic theory and efficient market theory, you ended up with this kind of shorthand, which was that volatility equals risk. And then because of the academics like to do lots of mathematics, and they like elegant mathematics, and you need a risk measure in your asset pricing models, it became almost academic shorthand. And so volatility is viewed as risk, but I don't think that is actually a very good measure of risk. I don't think it's the risk that end investors worry about. I don't think it's the risk that people are managing money should worry about. Risk is losing money, and it's losing money that you can't make back. And it's money that is in purchasing power units, not in today's dollars, like not in the nominal dollars, but in the real dollars. I want to be able to buy the same number of cans of Coke in 10 years as I can now. So inflation adjusted. So that's how we think about risk.
And you're not the only person to have highlighted this at the conference. Mark Mobius, emerging markets guru, said the single biggest risk at the moment is actually fear of volatility, is that, you know, if you've got to be in it to win it, and if market volatility puts investors off, then of course they can't make any gains. So with that in mind, with the idea that volatility is not risk, risk is real capital loss, what does that mean for the investor?
Often, taking a more lumpy return path, but for a higher return is a much better way to invest than aiming for sort of no volatility at all. Which obviously you can invest in cash if you want low volatility, but cash might not be as safe as some people expect either.
That was one of the things that you did say at the conference. Is based on the fact that what risk is capital loss. It's having less money tomorrow than you do today. Cash actually is a pretty risky asset because with such low returns being offered from deposits, with inflation on top, we've had very low inflation figures today, but that is expected to sort of even itself out back up to around 2%. Cash is risky.
Yeah, I think, for certain investors, nominal assets like cash and government bonds are important for them to hold. So leveraged institutions like bankers and insurance companies, they need to hold cash. They've got nominal liabilities that they need to meet. And many investors actually have nominal liabilities that they need to meet. They need to meet their daily living expenses. They maybe want to send their kids to college or to university. They maybe want to, buy a new car. And so knowing that you have that expenditure in the future, arguably you don't want to take risk with that. And so therefore, knowing that the dollars will be there to buy that is important. So therefore, having some cash or some, government fixed income security to match that liability makes sense. But overall, if you're somebody that's looking to fund consumption well into the future,
a pension, for example,
cash is incredibly risky because it doesn't produce anything, and it's in nominal terms. So therefore, as the value of currencies decline, or you have inflation, then the value of that cash declines. And so what we found is, if you look at the data for over 115 years across 21 separate countries, the average return for cash is negative. That is a negative real return. So if you held cash for 115 years equally in each of those 21 countries, you would have less today to spend than you would in, in other assets like equities. So for the true long-term investor, cash is actually a pretty bad asset to hold.
Daniel, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.